Good morning and welcome to Nasdaq Sector Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at MarketSite, we have Masood Galsi. He's with Nasdaq IR Intelligence, and we are going to focus on this market that is a rally of everything. Masood, as always, thank you for joining us so much at MarketSite. And the question really is, are markets overheated at this point? What continues to drive them?
Well, Jill, thanks for having me on your show. So as you noted, Bloomberg calls it the rally of everything. Nomura calls it buying panic. Essentially, on a year-to-date basis, we've seen stocks, investment-grade bonds, junk bonds, oil, nickel, copper, all the global names, global growth themes have been rallying pretty aggressively. A lot of analysts and pundits are claiming, are questioning now, are the markets overheated? Are they in overvalued territory? And there are two reasons, mostly two reasons behind this rally. One, we have a Federal Reserve central bank, what the Financial Times calls it, the policy U-turn. Essentially, they've turned more dovish, incrementally so. And when central banks turn dovish, they essentially inject liquidity into the system and take volatility out. So there's that dimension. And the second dimension is we have trade war optimism. Almost on a daily basis, we get presidential tweet talking about how things are improving. Structural issues seem to remain, but overnight we saw the delay in tariffs that shot up the Chinese markets by over 3% on heavy volume. So there's a lot of optimism there. It's interesting to note that only, like 6-8 weeks ago, we were in a bear market. Markets were down 20%. Now, all of a sudden, markets are up anywhere between 11 to 17%, led mainly by the industrials and energy and the cyclical sector.
Right. Well, it's really interesting to see as well the dichotomy with data, because if you isolate data, global macroeconomic data, it's a very different picture than what the stock market is telling you.
Oh, absolutely. So if you look at the macroeconomic underpinning, I'd like to think mostly because of the tariffs and trade tensions, it's slowed down global growth, U.S. growth. The soft data has been slipping. Hard data seems to be playing catch up. And if there's one thing that markets don't like, it's uncertainty. And over the last, up until December, over the last 8 months or so, we saw a lot of uncertainty in the markets. The global economic policy uncertainty index rallied climbed pretty extensively. And as a result, investors and also corporations got nervous. And when you get nervous, you have less capital expenditures. People wait to spend money. We saw manufacturing come down. We saw retail come down, the services. So the question now is really, with trade tensions potentially easing, will this all turn around? Right.
I mean, and the other question is, too, we know what the FOMC is doing for this year. They've telegraphed that clearly, right? Trade tensions, the can keeps getting kicked down the road as it has been. What's the next catalyst, right? So if we look at GDP going into Friday, how positive are you on that?
Well, if you look at across various outlets that release forecasts, I think Wall Street Journal has it around 2.5%. Historically, GDP growth in the United States since 1950 has been anywhere between 3 to 3.3%. The last 3 quarters, it was in and around 3%. I think shot up above 3.5% one quarter. But looks like Q4, again, the same topic. It's the slowing down of growth based on due mostly to tariffs and trade tensions. We're looking at anywhere between 1.4 to 2.5% Q4 growth. Now the question is, going forward, what would GDP look like? And I think all eyes are on future growth and future capex trend, and also the non-residential fixed investment data, which is also out this week.
All right, and to wrap up here, how do you think investors are positioning themselves a little bit longer term?
I think investors are generally cautious. I caught a lot of people by surprise, this huge rally that we're seeing. A lot of mutual fund flows, the likes of Lipper and Morningstar, are not showing a lot of institutional investor participation. Corporate buybacks are having a massive quarter so far. So I think investors are generally cautious. We're seeing a lot of flows into low volatility or risk mitigating strategies. So on the heels of the slowdown in global growth and trade tensions, I think investors have repositioned themselves. However, with this easing, it'll be interesting to look how that will change over time.
Well, let's go back to one more thing. You said, record growth for buybacks. Buybacks don't fuel future growth. CapEx and reinvesting into the business
Absolutely,
does.
Yes.
And I think that's why investors are cautious on the longer term, because where's that growth going to come from if you're only buying back stock?
Absolutely. So capital formation, one of the reasons behind capital formation is CapEx trends. And through various outlets, research reports, and analysts, they claim that CapEx is slowing. So a reading on the non-residential fixed investment growth would be interesting to look at this week.
All right, Masood, thank you as always for
Thanks so
joining
much,
us at MarketSite. And thank you for joining me throughout the week. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.